Okay, looks like everybody's managed to join. So good afternoon, everybody, and thank you for joining this Invest Engine webinar in partnership with Invesco, which is all about the BulletShares ETFs. I'm Andrew Prosser. I'm the head of investments at Invest Engine, and I'm joined today by Paul Syms, who's the head of fixed income and commodity product management at Invesco. So in terms of the plan for the webinar, it's hopefully going to be a bit more interactive than usual. Usually with these webinars, it's a bit more of a presentation, but this time, hopefully going to be a bit more of a Q&A. So I've got a few questions which I think people will likely want to know the answers to about how these ETFs work. So we'll start off with those, but I'm also going to be picking questions from the Q&A as well. So if you do want to ask questions as we're going through the presentation, you can click the Q&A button. It should be at the bottom of your screen. The questions, don't worry, the questions won't be broadcast to the whole webinar chat. They'll come straight to us. So don't worry if you think you've got a stupid question, that's absolutely fine. Just feel free to ask away and we'll answer as many as we can as we go through. I need to make sure I leave enough time at the end, probably no more than 5 minutes, for a quick demo of how to buy these ETFs on the Invest Engine platform. So I'm hoping that once we finish the Q&A, we finish the demo, we'll be ending the webinar at about 5:40 to 5:45-ish. So before we get going, finally, I do need to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. Okay, with that, I'm going to hand over to Paul to give an intro into who Invesco are. And then maybe as a first question, Paul, you can kick us off by going back to basics and answering the question, firstly, of what role bonds can play in a portfolio. And then maybe why is now a good time to be investing in bonds. And then after that, we can get into talking about BulletShares, if that's all right.
Great, sounds good. Thanks, Andy. So Invesco, who are we? We're a 1.7 trillion global asset manager. Almost 700 billion of our assets under management, or roughly 40% of our assets under management, are in index strategies. In total, on the fixed income side, we have a little bit over $500 billion in assets under management in fixed income and liquidity, of which about 60 billion is in indexed fixed income strategies. And I say that because we're going to be focusing on the ETF side of the business. On the ETF side of the business in Europe, we're the 7th largest issuer in Europe. And our total assets under management in Europe have just broken through the $100 billion barrier. So just looking at bonds and what role they could maybe play in a multi-asset portfolio. The way I see it is that there's really sort of two main roles for bonds. The first is that they tend to be less volatile than equities, and high quality bonds tend to have low or negative correlations with equities. So that really means that bonds tend to perform better when equity markets fall, which means that they may mitigate some of the downside risks that you see during periods of equity market volatility. But they're also useful to generate income, which will sort of be more of the focus for the BulletShares UCITS ETF range. Bonds usually provide a higher level of income than you'd get from equity dividends, and this means that they can be useful for investors seeking higher levels of income. And the ability to be able to combine income with principal that is paid back when a bond matures can make bonds useful when investing with specific financial goals in mind. As to why it's a good time now to be looking at bonds, I think, if you look at the last sort of 15 to 20 years, since the financial crisis, the global financial crisis back in 2008, interest rates and bond yields have been abnormally low. Central banks reacted to the financial crisis by cutting rates to extremely low levels. And a lot of central banks also introduced quantitative easing, which drove bond yields to very low levels. During the pandemic, there was further emergency policies put in place, which drove bond yields to the all-time lows. But following the spike in inflation that we saw post-COVID, central banks have hiked rates very aggressively. And that's pushed bond yields back to some of the highest levels that we've seen in the last 15 years. At this stage in the cycle, we're also looking at inflation having peaked. The central banks have basically done a good job in reacting to that, raising rates, bringing inflation down. And inflation is getting much closer to central banks' targets. And they're starting to cut rates. We've seen the Bank of England and European Central Bank cut rates. And the Federal Reserve in the US are expected to cut rates this month. And that's really, central banks are turning their focus to supporting growth rather than just bringing down inflation.
Yeah, that makes a lot of sense, Paul. Thank you. Let's move on to that first slide now, which the eagle-eyed people have had a chance to read. Let's dig into BulletShares. What is a BulletShares ETF, and why is it something we should be thinking about for our portfolios at the moment?
So BulletShares are a suite of ETFs that we've launched that have a final maturity. So they're effectively just like investing in an individual bond in some ways, in the fact that they have that final maturity. And it means that they can help investors plan their investment strategy around specific financial goals. By having that maturity, you are going to get a sort of a cash flow as a defined time in the future, which means that you can be able to use BulletShares to save towards certain goals.
So why would you use a BulletShares ETF compared to either an individual bond and then maybe versus a traditional bond ETF?
I mean, from an ETF perspective, from my standpoint, there's lots of advantages to ETFs and also specifically BulletShares, the fixed maturity type of ETF, rather than investing in either underlying bonds or more of a traditional ETF. The first thing I think to say is a lot of these advantages around the ease of trading and the benefits of being able to achieve a diversified exposure basically in a single trade. When you're looking at corporate bonds, which is the focus of our range, they normally have a minimum trading size, which means that unless you're a very large investor, an institutional investor, it's very difficult to be able to generate to invest in enough bonds to be able to create a truly diversified portfolio across a number of issuers. And it would also be quite costly to do so. As an institutional asset manager, we get very good prices in markets, whereas smaller trades tend to not receive the same benefits that we'd get as a large global asset manager. With a BulletShares ETF, you're basically able to get in a single trade access to several hundred bonds from many issuers, hundreds of issuers in a single trade with a fee that's starting at just 0.1%. And there's just the other benefits of investing in an ETF. You have the transparency, the holdings are published daily on our website, and they trade throughout the day. So basically, relative to the idea of trying to achieve a diversified portfolio, buying a huge number of bonds yourself, you're going to be able to do that much more quickly, efficiently, and at a low cost, and benefit from our trading relationships as a large asset manager. When you're looking at these compared to maybe a more of a traditional bond ETF, one that doesn't have a final maturity, BulletShares tend to sort of give you a more certain outcome if you're holding them to maturity, a little bit like holding an individual bond. So with a traditional ETF, a corporate bond ETF, it'll invest in a range of bonds across a range of maturities. Those maturities can go up to 30 years and possibly longer. And when you're looking at bonds, longer term bonds tend to be more volatile than shorter dated bonds. So this can lead to the overall ETF performance being more volatile too. And that may mean that if you're investing based on sort of a defined outcome, if you're saving towards a goal, you might be looking to maybe sell that ETF at a time when prices are low, when interest rates have gone up, that's driven prices on bonds lower, and that may sort of impact the amount that you get back from the amount you're going to sell. With a BulletShares ETF, they're only focused on bonds that mature in a specific year, the year of the BulletShares maturity. And that means that their volatility generally declines over time. It also means that investors have the ability to choose exactly sort of the tenor of their investment, whether they want to invest in an ETF with maybe 5 or 6 years to maturity, or one that just has 1 to 2 years to maturity. Or alternatively, and we'll look at this a little bit later, but the potential to maybe hold a range of ETFs, all with different maturities, which can provide you with a sort of a series of cash flows in the years to come.
So I think you kind of touched on it a little bit there, but how exactly do these ETFs mitigate that interest rate risk? Because we had a question on this in the chat as well.
Okay, so I think if we look at the next slide, and if you think about just sort of the way a bank deposit works or a money market fund, they're very sensitive to changes in interest rates. So when you're looking at money being held at a bank on deposit or invested in a money market fund, the returns, the interest rate or the return on that is going to quickly adjust to changes in base rates. So at the moment, as I mentioned, interest rates are close to the highest levels we've seen in the last 15 years. But central banks are expected to cut. They've signalled that a couple of central banks have started to do so, and it's largely expected that central banks are going to be cutting further in coming months. Which means that returns on cash or money market type investments are likely to decline as those rates come down. The way BulletShares kind of mitigate that risk is by effectively locking into the rates that are currently offered in longer maturities. So basically, you have here sort of an idea of the dynamics of a BulletShares ETF. Basically, that if rates go down, if interest rates, if central banks cut rates, rates go down, the yields on the bonds in that ETF will fall. However, and any new bonds that we may be buying for that ETF will also enter with lower yields. But what you have, because bond yields, when yields fall, bond prices go up, that will push the NAV, the net asset value of the ETF up. So overall, what you'll have is declining income, but a higher NAV, a higher price of the ETF. So the two of those kind of offset each other to a certain degree, and that means that the overall total return will broadly balance out. Similarly, when rates rise, the opposite will happen. You'll get new bonds coming in at higher yields, but the prices of the existing bonds in the ETF will have gone down slightly. But that will kind of offset to a degree. So effectively, you're kind of being able to lock into the yields that are available on longer dated maturities now, rather than just accepting what central banks do to base rates.
Yeah, and I think there was a question chat here about withdrawing funds before the specified maturity year. I think that kind of links into what you were saying before about some of the advantages of the ETF wrapper versus buying individual bonds directly. So are you able to withdraw funds before that specified maturity year? And if so, how would that kind of affect returns if you withdrew the funds before the maturity date?
So yes, you can. As with all ETFs, they're available to trade through the day, every day that the markets are open. So you can buy and sell at any point. The risks with that are like any long-term investment, that prices can go up or down. So the idea of a fixed maturity ETF is that if you are holding it to maturity, the yield on the day that you invest will be a reasonable indication of the annualized return that you're expecting to get over the lifetime of that product if you hold it all the way to maturity. However, during that period, say it's a 5-year bullet, a sort of a 2029 maturity, yields are going to go up and down, prices are going to go up and down in the meantime. So if you do want to withdraw, you can do so. You can sell your entire holding at any point, but you will be slightly at the risk of where market prices are at that moment in time. So it just takes away a little bit of that certainty. But obviously, situations change, and if you need to withdraw the money, you can sell the ETF at any time.
Yeah, so in terms of how to kind of think about these products, in terms of the returns that you can expect, are your returns going to be highly correlated to that starting yield if you hold over the life of the fund until it reaches maturity?
So that's going to be a very good indication of your annualized total return. As I say, it won't be perfect because there will be new shares created as more investors come in at different prices, and there'll also be sellers throughout the lifetime of that product. But the yield on the time that you invest will be a good indication of the annualized return that you could expect over the lifetime of that product. So it's really, as I say, if you look at where markets are and being able to lock into those forward rates, it's just the forward yields that are available in sort of 2, 3, 4, 5 years out. It's just giving you a good indication of what you might be able to achieve on those products if you're holding them all the way to maturity.
Yes, and how does it do that? What sort of bonds are included under the hood of these ETFs?
So our current range is focused on US dollar denominated investment grade corporate bonds. So investment grade really referring to the group of credit ratings that indicate that the issuers here have sound credit quality. They have low to moderate credit risk and are much less risky than bonds that are rated sub-investment grade or high yield. Each bullet share will only include the bonds that mature or are due to be called in the year of the maturity of that ETF. And then there's just a slight nuance in the final year. As we get towards the final year, due to sort of liquidity and the way the market's going to behave, and if you think about, we're buying bonds that mature throughout that final year. There'll be maturities going on throughout the year. In the first 6 months, any of those maturities, the proceeds from those maturities will be reinvested into corporate bonds that mature in the second half of the year. From the 1st of July onwards, for liquidity purposes, we'll start reinvesting any of those proceeds into US government bonds and T-bills, largely because they're more liquid. They're just more efficient to trade in that final 6 months of the life cycle of the ETF. And also just from experience and the way we see investors using these products, as they get close to maturity, we quite often do see investors selling slightly ahead of the maturity date. Volatility on the pricing will be very low by then, because you are getting close to a product that is very close to maturity. So if they need the cash slightly before, a couple of months before the final maturity, then we might see some selling there. So we move into more liquid bonds, the US government bonds and the T-bills.
And it's December, if I remember rightly. Is that correct, Paul? So December, if you've got like a 2026 BulletShares ETF, it's December of 2026 that it matures.
Yes, so all these mature in the on the second Wednesday of December. So that's the final maturity date on all of these.
So you'll be getting your quarterly dividends throughout the life of the ETF, and then at maturity, the NAV of the fund is distributed to the ETF holders. Is that how it works?
That's correct. So in dollars, we do have accumulating as well as distributing. So you can choose to have any of the dividends to be reinvested. In us, we do offer a sterling hedged share classes across the range for investors that want to minimize currency risk, and they are distributing. So they'll pay out quarterly distributions, and then at the final maturity, they'll pay out the proceeds that are due at the end of the life cycle of the ETF.
Yeah, and I think it's probably also, we've talked a lot about the benefits, but it's worth focusing on the risks as well. Obviously, none of this is without risks. So what do you think are the primary risks that investors should be bearing in mind and be aware of when considering investing in these types of ETFs?
So I think the primary risk is that you are investing in corporate bonds rather than cash. These are sort of a way of sort of saving towards a goal. But because you're moving into bonds rather than just into cash, prices of the bonds can go up and down, as I mentioned, and therefore the price of the ETF will go up and down at the same time, which means that, as I touched on before, if you need to sell before maturity, certainly if it's sort of more like a couple of years before maturity, you may be selling at a time when prices are depressed, and that does mean that you may not get back what you invested in the first place. There's also credit or default risk, but these products are focused on investment grade bonds, and default risk in investment grade is pretty low. So as I mentioned as well, rather the sort of comparison against individual bonds versus the ETF, this is investing in several hundred bonds. There's sort of between 400 and 600 bonds in the index of each of these in the indices that these ETFs are tracking. So it becomes very, very diversified. So the other sort of risk within credit markets is that there will be a credit rating downgrade. But because each issuer is quite a small percentage of it, you're going to have far less concentrations, far less issuer-specific risk than you would if you were investing directly in a range of individual bonds yourself.
Yeah, that makes sense. Always worth bearing the risks in mind when you invest in any of these ETFs. You've also been running these for a while now. How have you seen clients use these ETFs, and how do you think these ETFs should be used in investor portfolios?
So, I mean, the way we would see it, as I say, this is very much about coming up with a a range of products that can help investors sort of to save towards specific goals. One of the ways that we look at this is around bond laddering. So if you kind of think about bond laddering and the way that investors could use these. So I think actually on the next slide, or the next slide but one, the idea of bond ladder is that it's a laddered portfolio consisting of several bonds with different terms to maturity. And by investing in that laddered portfolio, an investor can receive the income and maturity proceeds from those bonds to meet specific financial goals. You can do a very similar thing by using a range of BulletShares ETFs, by investing in several different maturities across the different years to create an ETF bond ladder, which can help to mitigate those interest rate risks that we mentioned earlier, while providing cash flows to potentially help when saving towards those specific goals. And the idea of this, if we turn to the next slide, you can kind of get an idea of the way you might want to use some of these within laddering, and also reinvesting and paying for sort of specific goals that you might be wanting to save towards. So if you look at this as an idea, sort of year one, if you invested across the range of ETFs there, and held them over the first year, you might be sort of in the 2026 maturity be looking to save towards a holiday, a big ticket item. And if you're fortunate enough to be able to put enough into that, you'll be saving to that. As that comes towards its maturity, you can take the amount of money out of the maturity proceeds that you need for that holiday. If you don't need it all, you can then reinvest some of that into a future, a longer dated bullet for further goals. And you can imagine, you can keep going along here. We have some ideas here, you know, whether it's a car purchase, whether it's school or university fees, if it's maybe a longer term goal, maybe saving towards a house deposit, but you can keep rolling this on. And I should have mentioned that our initial range that we've launched is 5 maturities from 2026 through to 2030. We'll be looking to launch a new bullet in each year and years to come, so that those investors that want to roll further out the curve to a new maturity will be able to do so. So some investors will need to withdraw all the money at the time of the proceeds, but if you have the ability to roll that into a future BulletShares ETF, then you can keep that money invested, keep rolling it out, and keep sort of locking in those rates that are on offer further out the curve, and giving yourself that sort of defined cash flow that you're going to get. It's not it's not an exact cash flow, but you'll have a reasonable idea based on the yields on the time that you invest, as to what you will be able to achieve by the time that the ETF matures.
We've had a couple of questions come through on cost as well. I know you mentioned they were from 10 basis points, so 0.1%. Is that representative for the whole range? And also another question here, are there exit fees if you leave the investment early? So
the dollar denominated share classes are priced at 10 basis points. The sterling hedged share classes are priced at 12 basis points. So there is a small additional cost for that hedging fee. As for the cost of getting in and out, these trade on exchange. So you can get a price in the market every day. You'll be able to see that. There's no sort of actual specific redemption fee, but the price is there on the market should you wish to sell those on any given day.
And there's obviously no trading fees on Invest Engine, so nothing from our side either, which I think is one of the big benefits of having the ETF wrapper as opposed to the direct bonds. I think it might be worth just kind of drilling down into what happens when the fund reaches maturity, because I think that's not the most intuitive, because that is the bit that differentiates it from a kind of bog standard bond ETF. So I can see we had a question on chat, which is why I'm asking. What happens when the fund reaches maturity? Does it just sell down all the bonds that it has and then pays out as cash?
Yes, it is the simple answer to that. So as I sort of said, on that final year, what you're having is in the first half of the year, as I say, this will be a range of bonds that are maturing each month throughout the year. The final maturity date is the second Wednesday of December for each of these in each of the years that we have a BulletShares ETF for. In that first half of the year, proceeds from any maturities, corporate bond maturities, are reinvested into corporate bonds that mature in the second half of the year.
I think there's a slide on this, right? If we might just go back a couple of slides, I think there's a slide that illustrates that quite well. That's the one, yeah. There we go.
That one. So that they get reinvested into corporate bonds that mature in the second half of the year, and that we've looked at this. That just, you know, the idea of these being corporate bond exposures, that keeps you invested in corporate bonds and getting there's a small additional yield that you'd normally get on corporate bonds relative to government bonds. So this keeps you invested, giving you that slightly higher yield. In the second half of the year, as I say, what we'd expect to see is some investors will be selling some of their holdings down because not everybody needs their cash flow exactly on the 14th of, or the second Wednesday of December as the maturity. Some people will need that money a little bit earlier. So this will reinvest any of the proceeds into US government bonds, so US treasuries or T-bills that mature on or just after that second Wednesday of December. So basically what will happen is, as we get into December, the portfolio that's remaining will be primarily US treasuries and US T-bills that all mature within a couple of weeks of that second Wednesday of December, and there may be a few remaining corporate bonds that mature around that date. They will be sold down into cash, and the cash proceeds are returned to the investor.
Yeah, that makes sense. Just touching on the corporate bonds there, what's the kind of average credit rating that we're talking about with the underlying bonds? Sorry to put you on the spot there.
So actually, let me just. So we're around, I think the average is sort of single A minus for the 2026, but then sort of triple B plus for the 27s onwards. It tends to be around that sort of cusp. So it's safely inside investment grade credit. So triple B plus being a couple of notches above the cutoff between investment grade and high yield.
So highly rated by the credit agencies then.
So highly rated on average, as I say. If you look at corporate bonds investment grade corporate bonds are the higher quality, lower credit risk end of the spectrum. When you get below triple B minus, you move into high yield space. It used to be called junk; it's now called high yield. As a slightly nicer name, but it's definitely a riskier area of the market. Obviously, from a risk return perspective, if you look at high yield ETFs, you tend to get a higher yield on those bonds because you're getting you're taking on more credit risk, so the higher yield is offering you the higher potential return. But we focused on investment grade credit for these ETFs.
And I think that brings us very nicely to the platform demo. About 5:30 now, so actually slightly ahead of time, which I think is the first time ever for these webinars. So I will just share my screen now. So I've just requested to share my screen. So let's see if that works. There we go, perfect. And I'll just do a quick run through of how you can see these things on InvestEngine. There we go. It looks like I'm sharing correctly now. In the meantime, while I run through this, please do feel free, keep the questions flowing. We'll answer as many as we can at the end. We'll still have a bit of time after this demo because it shouldn't take more than 5 minutes. And if we don't manage to get to your question, then we'll get back to you after the webinar. But anyway, here we go. We have a dummy account set up here to walk through. So once you're logged into the InvestEngine app on your phone or on your web browser, you can either open a new portfolio or select your existing one. I'm going to select this DIY one here, which has got 50% in equities, 50% in bonds, which if we scroll down, we can see here. So what I'm going to do here is I'm going to click Add Securities. This is how you change the composition of your portfolio. And then nice and easy, we're just going to click the Invesco banner there, which brings up all the Invesco ETFs. You can see they've got a whole range of nice cheap ETFs on here. but we've been talking about the bullet shares today. So I'm just going to plug in bullet shares to the search bar up here. And here we go. We've got all of the 5 US dollar. They're all hedged to sterling. I think there was a question on this in chat. So it's the dollar corporate bonds, but they're all hedged to sterling. So they are 0.12%. And we've got all the different maturities here. You can see, as Paul was mentioning, we've got the 2026 all the way up to the 2030 on the platform here. So we'll just pick this top one, 2027. And then we want to click add to portfolio. Very good. You can see at the top there, top right, it's been added. So we just click continue. And let's say I want to have 50% in that. And I want to reduce my existing bond exposure to 0. That will change my target weights if I click continue. Here you can just have a nice look through of all your kind of equity, look through all the regions and the sectors and the individual holdings in your portfolio, which is kind of cool. And then we'll just save and continue. And then I should get a nice pop-up saying that my target weights have been updated. Yeah, there we go. So we will click continue. And if I scroll down now, fingers crossed, yeah, here we go. You can see here, this 50% here means I have a 50% target weight in the 2027 bullet shares, and my existing bond ETF has gone down to 0. So that means we're done. All we need to do now is fund the account, which you can do if you go through the invest button here, or you can set up a savings plan using this button here, which allows you can kind of invest weekly or fortnightly or monthly. It's all very straightforward. So that's, in a nutshell, how to access the BulletShares ETFs on the Invest Engine platform. Again, there's no trading fees. I think I did see a question about the different wrappers. This is obviously available in your ISA, in your SIP, or the general investing account, or wrappers. It's available for, so no problem with that. I'm just going to stop sharing now and see if we've got any questions to pick up just before we close out the webinar. Let's have a look. Someone asking if we only have the investment grade ETFs, and yes, I think that is correct. Is there a webinar to teach you how to use the Invest Engine app? Hopefully that platform demo, I know it was a bit quick, but hopefully it was a crash course on how to use it. It is pretty intuitive. So I just say log on and have a play around. Let's have a look. Is there a risk of losing value, of the fund losing value, I guess, when moving into those treasury bonds at maturity? I think that's one for you, Paul.
So as I say, the idea in that final 6 months, or just under 6 months of the BulletShares life, is to move more towards more liquid instruments, because sort of experience tells us that investors will start selling down some of that ETF. And there's also in the final 6 months there are it just becomes a little bit less liquid to invest in, to be able to trade corporate bonds. So we're moving into more liquid, more easily tradable instruments. It does mean that the yield will fall slightly as we move to higher quality government bonds rather than corporates. But then that will give us the liquidity to ensure that any investors that need to sell down their holdings, we have ample liquidity in the ETF to be able to do that. As for government bonds, US Treasuries, you're sort of moving away from credit risk, because you're moving towards governments that are safer bonds by their nature.
Yeah, we've had a question here on the yields, and obviously I think this is one of the primary reasons why people would decide to invest in these. Have you got the yields to hand there about all the different maturities and what they're currently yielding?
So we have them on our website. They're updated daily. I don't have everything to hand. I'm just trying to see. I have them as of the end of July. We were across the range at the end of July between 476 and 489. So if we actually there was a slide with the yields of AA corporates. They're not quite in line with the ETFs themselves, but yields have come down a little bit. I did see there was another question about the return. And as I mentioned earlier, when bond yields fall, the price goes up. So actually, the return has been higher than you'd expect in the short term, because yields have started to come down. Yeah. As I say, when you're looking at when you're looking at the way the ETF works, you're kind of locking into that yield. So anybody that bought a couple of months ago has benefited from prices on the bonds that are held in the ETF going up as yields have come down. As I say, if you're looking at what central banks are expected to do, their rates are expected to come down further. So that there's potential that yields could fall further in months to come. Obviously, that's going to depend on lots of factors around inflation and the economic outlook. So there's obviously no sort of a guarantee around this, but if you're looking to try and lock in those longer term yields, then this is potentially one way of looking to do so, as opposed to sitting on cash at a bank or in a money market fund, where those yields or returns are likely to come down more quickly.
Yeah, and I think the increased certainty is really helpful as well. I really like that slide that you had with the kind of seesaw, with the even when yields go down, your total return goes up. When yields go up, your kind of price return comes down, your income goes up. So yeah, thank you, Elspeth. That's still on there. So I think that's a really big benefit of these ETFs over a kind of more traditional fixed duration bond ETF, where it moves quite heavily with interest rates and it's not always certain what you're going to get over any given period. But with these ones, if you hold to maturity, there's much more certainty over the total return that you're going to get, which, as Paul mentioned, is really highly correlated with the starting yield that you can see on the Invesco website. I just had a look while you were talking there, and it looks like the yield to maturity for the 2027 or 2027? Let me just double check. 2026, sorry. At the moment is 4.38%. So those are the sorts of yields I think that we're looking at the moment, which is for locking in over that period, I think really attractive, especially given where interest rates are supposed to go.
Thanks.
Right.
I was trying to do exactly the same thing myself.
Yes, all right. We've got a question here on how often payments are distributed. We've got the distributing share classes on InvestEngine here. I almost called it Invesco there. InvestEngine. So they're quarterly dividends. That's right, isn't it, Paul? Quarterly.
Yes, quarterly. In March, June, September, December.
Yeah, and they are hedged. So I know when you log on to the platform, you'll see them as USD in the title, but they have all been hedged back to sterling. So that's not a consideration. The FX movements between dollar and sterling are hedged out by Invesco. So it's not something that investors need to be too worried about there. Right, okay, I think we are getting towards the end of the questions now. If we haven't answered your questions today, I can see there's some about tax, which always difficult for us to answer. We generally say that we're not tax experts and you need to consult a tax advisor if you do have any specific tax questions about these things. We've got someone just chipping in last moment asking how we see the yield. If you go onto the Invesco website, just Google Invesco BulletShares. Make sure you go on the UK website rather than the US one. But there are individual fact sheets for each of the ETFs on there. And you know that if you kind of match the tickers to what we have on InvestEngine, there's B26G, for example, is the 2026 BulletShares ETF, and it's about kind of a quarter of the way down the page. There's a section called Yield Information, and that's got the yields for you there. Yes, as I was saying, if you have any questions, you haven't managed to ask them today, just email us, support@investengine.com with your questions, and we'll get back to you that way. But if you do want to find out more about the Invesco BulletShares ETFs in particular, obviously go onto the Invesco website. There's a good trove of information there. Also, if you click that Invesco banner at the top of our ETF range page, you can find all the details there. Okay, I think all that's left for me to say, thank you, Paul, for joining. I know a lot of people are invested and interested in these ETFs, so hopefully today's webinar has been useful for our viewers. I can see there's a lot of Q&A going on. There's lots of participants, so it looks like it's been a pretty engaging webinar. So thank you all for joining, and we'll see you next time.
Thanks, Andy.